Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. Just a heads up at the beginning of today's video. Today's video is very macroeconomic focused. We will discuss other major developments, including the leadership change in Hong Kong from over the weekend in tomorrow's video. And as always guys, if you get some value from this episode, don't forget to hit the like button. And anyone who wants to go the extra mile, Patreon, Buy Me a Coffee and crypto links are in the description below. Or for the first time, if you want to support the video, check out today's sponsor. I'm very excited to introduce you guys to the first official sponsor of China Update today, but I'm getting ahead of myself. More on this later. First up, over the weekend, Premier Li Keqiang, in a special teleconference of provincial leaders across the country, warned of a, quote, complicated and grim outlook, end quote, for the job market, and urged local leadership to, quote, take stronger action to stabilize employment, end quote. Yet another sign of growing alarm in Beijing over increasing unemployment numbers, which are likely worse than the already concerning official numbers suggest. Recently, we have been discussing the deteriorating employment situation in the country, which was already in a poor state of affairs before the most recent round of lockdowns. Two particularly vulnerable and politically dangerous groups facing tough employment conditions are university graduates, which are at their highest levels in Chinese history, and migrant workers. Both groups have limited opportunities and income levels are perceived as very unattractive. Leadership in Beijing understands very well the risks associated with these groups being out of work. Indeed, at this special meeting, Li Keqiang expressed, quote, the main focus should be on the employment of key groups such as college graduates, migrant workers, especially poverty-stricken laborers, and urban residents with financial difficulties. End quote. Okay, up next for the Chinese economy, Chinese energy experts at a recent conference late last week in Beijing have warned that China may pay nearly $100 billion more for the crude oil it imports this year, causing, quote, costs to ripple through its economy, end quote, according to one speaker at the conference. Power plants are especially going to feel this pain, with many already operating at a loss since last year. One source at a state-owned national gas power plant, speaking to Chinese financial media, recently leaked that, quote, power generators are definitely losing money, end quote. This extra volatility in the global energy market will also likely push many Chinese industrial sectors and industrial users to rely more on coal, something which we shouldn't find too surprising as we have been following official policy changes in recent months to greatly increase coal burning capacity. While China is a massive miner of coal, much of the coal that it needs for its industrial production and power generation has to be imported because it's the wrong type or it's of an insufficient quality if it's sourced domestically. Now, we have a few more major economic developments to cover in today's video, but first, one of the reasons we need to be following developments in the world's number 2 economy is to stay one step ahead of the markets and maintain a sound investment portfolio. With increasing inflation, unstable macroeconomic trends, and shaky capital markets, diversification into alternative asset classes is more important than ever. And one historically well-performing asset class is artwork. Indeed, the value of blue-chip art has outpaced the S&P 500 by 180% from 2000 through to 2018. In the past, however, investing in artwork was limited to the super wealthy. But today's video sponsor, Masterworks, is changing that. Based on research in art trends and appreciation value projections, Masterworks purchases art and makes it investable to Masterworks members only. The art is then held over time until Masterworks finds the best time to sell. Once sold, the returns are distributed to the investors. Since 2017, Masterworks has exited 3 offerings, offering net annualized returns of 32% in 2020 and 31% in 2021. Masterworks is giving regular folks folks like us the opportunity to get in on the art investment world. Signing up is super easy too. It took me less than 60 seconds. If you want to skip the waitlist for some of the most popular pieces, click the link in the description below. We remember that all investment involves risk. Always speak to an investment professional if need be before making any major investment. A huge thank you to Masterworks for sponsoring this episode of China Update. Okay, next up, I wanted to unpack an ongoing debate within and outside of China regarding the cost of mass COVID testing and whether mass testing will help or hurt the Chinese economy. Now, we touched on this a little bit last week, but I think it's worth unpacking some more as it's becoming increasingly relevant as more cities look to implement massive testing policies. For example, as of the filming of this video, at least 11 large Chinese cities, including Beijing, the capital, Shanghai, and Hangzhou, have introduced regular mass testing, and more cities are likely on the way. So how much would mass testing rolled out across the country cost? Well, Goldman Sachs, in a recent research note, has the most conservative estimate, claiming that the cost of testing China's Tier 1 and Tier 2 city residents, representing about 30% of the national population, could only amount to about 0.2% of GDP over the second half of this year. Bloomberg economists, on the other hand, have a higher estimate, finding in a recent report that the cost to test half of China's population every 2 days for a year would be about 900 billion yuan, or $135 billion, or about 0.8% of 2021's nominal GDP. Of course, these are not perfect comparisons. Each has different methodologies and assumptions, but it starts to give us a ballpark idea of the costs. Nomura Holdings Limited had one of the highest estimations, with estimates placing the cost of testing around 1.8% of gross domestic product, warning that such a policy expansion would be a, quote, huge drag on growth, end quote. The Nomura economists said testing 70% of the population every 2 days would amount to 8.4% of China's fiscal expenditure. That's based on the cost of a single person PCR test of 20 yuan, just a couple of dollars. Bloomberg's estimates were based on tests costing 8 yuan. This is RMB, the national currency of China. Of course, there are other costs to consider. If hundreds of millions of residents need to take 30 minutes to an hour out of their day every 24 to 48 hours to do a test, that's billions of hours of lost time. An opportunity cost which could have been spent resting, working, or spending time with family, etc. There is also the opportunity cost of government spending. To pay the huge cost of billions of tests, local governments will either need to cut spending somewhere else or take on more debt. On the other hand, the Goldman Sachs economists argue that, quote, paying for mass testing in large cities may be effectively a major stimulus as it could allow production and consumption to proceed, end quote. Perhaps, but as we have seen with March's economic data, both private sector investment and consumption decrease when there is a fear of possible lockdowns, so it's difficult to know how stimulating mass testing would be for economic growth. The Goldman economists also argue that if mass testing prevents lockdowns, then the cost of testing is easily justified. However, other economists and public health experts argue that this can be achieved through much smaller scale targeted testing, and that mass testing is not necessary to achieve this end. Okay, next up, despite Shanghai authorities claiming that much of Shanghai's and the wider Yangtze River Delta's industrial production has come back online, many key foreign factories are complaining that they have not been permitted to resume operations. Indeed, a majority of Japanese and European companies in the industrial megacity remain closed. According to a recent survey of Japanese firms operating in Shanghai, almost 2 in 3 Japanese factories have yet to resume any production, while another 28% are running at less than 30% capacity. So incredibly, only 1 in 10 Japanese factories are operating at anything nearing capacity. The situation paints a very different picture to the claim of local authorities that, as of late last week, more than 70% of industrial firms had resumed production. Either this number is inaccurate, or foreign companies are not being prioritized by the city, or some combination of both. More than half of the Japanese firms surveyed said that they were unable to source any supplies, and 90% of Japanese companies surveyed said their biggest problem was logistics. We remember on Saturday we discussed a similar finding from European Union factories operating in Shanghai. Indeed, according to Maximilian Butek, the executive director of the German Chamber of Commerce in China, European factories are facing similar production issues, expressing, quote, "Functional supply chains, as well as the lack of sufficient amount of lorries and drivers, make operations difficult, even if permissions for work resumptions are granted." End quote. In terms of what this all means for economic activity and business confidence in Shanghai, Mr. Butek puts it bluntly, quote, "The majority of investments are put on hold. Your investments are difficult to justify as long as the zero-case policy remains the strategy for the authorities." End quote. In the most recent European Union Chamber of Commerce in China report, the percentage of European Union businesses considering moving current or planned operations out of China has reached a 10-year high, and this percentage has doubled since the beginning of this year. We should point out that the southern technology megacity of Shenzhen, unlike Shanghai, has managed to run its factories at or near full capacity, all while adhering to China's dynamic zero COVID-19 policy and going through a short lockdown period earlier this year. As we will explore later this week, though, these disruptions and lockdowns may also be simply accelerating a process already well underway. That is the process of global supply chain restructuring away from China as customers steer more orders to Southeast Asia with less supply chain risk, or, in the case of customers in developed economies like North America, Europe, and Japan, increase investment in their own home markets.